Good morning, everyone, and thank you for attending today's webinar. My name is Sharak Shahabi-Azad, Senior Director of Research at the Global Risk Institute, and we're glad that you have taken the time to join us today for the fourth event in our macroeconomic policy webinar series, Financing Nation Building, Capital Flows in and Out of Canada. Before we get started, a quick reminder that the webinar is being recorded and the video will be posted to the GRI website in the next few days. Your microphones are muted to avoid background noise. And if you have a question for our presenter, please submit it through Slido, which will appear on the right side of your screen. And in case Slido isn't accessible to you, feel free to submit your questions through the WebEx chat. And finally, near the end of the webinar, you'll be asked to fill out our event survey. It's very short, and we thank you in advance for taking a moment to rate today's session. Now, if you were with us for the last three webinars in the macro series, you'll know that the impacts of uncertainty due to U.S. tariffs and trade policy have influenced how our guest speakers viewed the macroeconomic environment and Canadian economic performance, growth, and even the housing market. The Canadian economy faces many headwinds, and as of last month and the outbreak of military conflict in the Middle East, another set of negative factors have been added to the list with yet unknown economic consequences. To that end, it is my pleasure to welcome Royce Mendez, Managing Director and Head of Macro Strategy at Desjardins Group, where he leads the team responsible for forecasting and analyzing the Canadian macroeconomy and financial markets. Since joining Desjardins in 2022, Royce has become a sought-after commentator in the media, and he's known for his ability to distill complex dynamics into clear, actionable insights. His commentary has a wide following across the financial sector and the media, helping Canadians make sense of the shifting economic landscape. Today, Royce will be guiding us through a set of issues that are front of mind for many of us. He'll discuss the state of the Canadian macroeconomy, our fiscal standing and debt profile, which remain critical determinants of investor sentiment and sovereign risk pricing. All of this in the context of the sustainability of current capital flow patterns. For now, strong demand for Government of Canada and provincial bonds has helped anchor sovereign and benchmark yields. These yields serve as foundational pricing references for a wide range of private sector assets, influencing everything from corporate borrowing costs to valuation in the real estate and infrastructure. Whether or not these trends hold are yet to be determined. Royce, thank you for joining us this morning. We're eager to hear your presentation. Over to you.
My pleasure. Thank you, Sharak, and thank you everyone for joining. Thank you to everyone at the Global Risk Institute. I have deep respect for the work you do, and I'm very interested in this series that you're providing. The first thing I'll say is I'm really pleased not to be talking about the daily news cycle. I'm very interested in the topic of global capital flows coming into Canada, and I'm very happy that is the topic of our discussion today. So why don't we jump right into it? As Sharak alluded to, last year was a very tumultuous time for the Canadian economy. We were faced with a massive trade shock and uncertainty hanging over the Canadian economy at large. What you will find maybe surprising and comforting is that it was a record year for capital inflows into both Canadian fixed income funds and into Canadian equity funds. Really remarkable given all of the uncertainty about the domestic economy. I'll show you a little bit. I'll break this down. I'll go into fixed income and equities a little bit deeper, but you can see here that it all sort of started around the US presidential election, November 2024. You can see there, that's when the green line, the cumulative flows as a share of AUM into intermediate and long duration bond funds really started to pick up in Canada. And we started to see quite a wide divergence with the US. The two had been tracking quite well before that, but it seemed like, if anything, that there was less interest in the US, at least for a period. And you can see that over the subsequent 18 months or so, we've seen that divergence widen. And it's been in large part, not all, but in large part, because foreigners have been scooping up Canadian debt at a remarkable pace. This is the foreign buying and selling of Government of Canada bonds. On the left-hand side here, I show you in dollar terms, and of course, we're at a record. But even as a share of outstanding, you can see that it is a very strong period of foreign buying of Government of Canada bonds. Maybe not at the same magnitude as we saw just after the financial crisis in 2009, but certainly a longer duration of uninterrupted foreign buying. And that really speaks to, I think, the global demand for Canadian assets and specifically Government of Canada bonds. And you can maybe see it here as we look at just the top left-hand slide, the top left-hand chart here, the ownership shares of Government of Canada bonds. The red is non-residents, and non-residents make up a significant portion now of the ownership share of Government of Canada bonds. You can see that is where the foreign demand is most apparent, but not the only place where it's apparent. You can see it in other Canadian bonds as well. Turning to equities, it's a broadly similar story, particularly in 2026. You can see here that cumulative flows as a share of AUM going into Canadian equity funds is, really very clearly outpacing anything else that we can compare it to in the developed market. Asia Pacific, the US, Europe, really strong demand for Canadian equities, and that's very unusual. You can see it on the right-hand side there. We are basically outpacing even the 90th percentile of increases we've seen for the last many years. Very strong inflows into Canadian equities, and if anything, they have accelerated early this year. This data goes up until the middle of last week, so it's very current, even in the very chaotic environment that we currently live in. And part of the reason is that heading into this year, what we saw was that many investors around the world were actually underweight their equity allocation to Canada. So we think about this in terms of equity allocations, what is the benchmark, and where are all these countries' investors versus that benchmark? Well, you can see every one of these countries we've listed here is underweight Canadian equities versus their benchmark, other than the US. And so we have seen very strong buying globally. And I'll talk about this in a little bit, but one of the overall themes is that this global rotation, maybe marginal, maybe very large, away from the US is benefiting Canada. You're seeing it both in fixed income and equities. We're seeing much more interest in putting money to work in the Canadian economy, in Canadian assets. But this is not only isolated to portfolio flows. We also want to talk about foreign direct investment. Prime Minister Carney recently cited the very strong numbers for foreign direct investment, and it's absolutely right. I mean, you can see here that foreign direct investment for the past few quarters has been quite strong. We went through a very long period, 7 years or so of soft foreign direct investment, and now we're finally starting to see a pickup. A lot of the money now is coming from Europe, the UK, the European Union, and we are seeing interest again growing in the country's assets. We've also seen something interesting, and I'll talk about this throughout the presentation, with regards to domestic investors allocating money outside of Canada. So here is a chart of Canadian direct investment abroad. The left-hand side is all countries. The middle chart is the United States, and the right hand is other countries. What you can see very clearly is that new investment headed to the US dried up last year. I mean, it very much coincided with the difficulties between the two countries on trade. And it does seem like that there was much less appetite for Canadians to put money to work in investing in businesses or whatever it is in the US than there was previously. I mean, really remarkable evaporation of the demand for new investment into the US. You can see actually that it turned into divestment. I mean, a very rare occurrence. But you look at other countries there, and there is a bit less appetite even for other countries more recently in the most recent periods. And I think this is maybe the result of two factors. One being is that under a cloud of uncertainty globally. Maybe there's just less interest in putting new money to work and more interest in keeping it in very liquid forms of assets. But also, I think this reflects a big turn in the sentiment of domestic investors. We've heard for some time now that the very large domestic investors want to put more money to work. And this has been a big theme of our research for a long time. I mean, this is not something new. We've been hearing it from our contacts across the investment community in this country that the big investors want to put more money to work in Canada, and they're looking for ways. And I'm going to talk about that in a second. But why is there this maybe huge interest globally and domestically to invest more money in Canada? As I said, I mean, the economy was not performing really well. I mean, we're looking at another year of maybe very muted growth here in Canada. So what are the reasons that are leading investors to want to put their hard-earned money to work here in Canada? Well, I would argue that it's, the fiscal capacity we have just from a starting point. You can see Canada is one of the very few remaining AAA rated sovereigns. You can see it is there in that dark green. But even from a general government budget balance perspective, that includes the federal government, provincial governments, municipal governments. You can see the budget balance is much narrower than that of what we would consider our peers. So I would call Canada's fiscal position as the cleanest shirt in the dirty laundry basket, and that is appealing in a world where debt is accumulating very quickly at the national level in most developed market sovereigns, and very little end in sight to that accumulation. It is key for investors to focus on jurisdictions that seem more stable. I mean, we have arguments here in Canada about the fiscal position of the country, but when it comes down to it, I mean, we are better positioned and less fragile to some of the risks that are currently materializing around the world than our peer economies. You also saw, I mean, generally a sentiment change early last year when Prime Minister Carney took over, and he announced a pretty ambitious plan, achieving $1 trillion of new investment over the next 5 years, exporting an additional 1 million barrels of oil per day to Asia through a new pipeline, replacing lost U.S. export demand with domestic demand by reducing interprovincial trade barriers, doubling non-U.S. exports over the next decade, and spending less on government operations. I mean, those are very worthy goals. And at least at first, the sentiment globally was that Carney had the skills and maybe the abilities to be able to get some, if not all of this done. I would say that this is a very ambitious list. We have seen some progress here. We've seen spending less on government operations. We have seen increasing exports to non-U.S. destinations. And so, we've seen some progress, but I really think that we're moving from the phase of sentiment turning right now. Over the past year or so, we've seen sentiment turn, and that has generated a lot of excitement and enthusiasm and investment into the country. And now we're in maybe the show me phase. Now we really have to see whether or not the federal government, along with the provincial government, along with all other stakeholders across this country, can come together to get some of these ambitions and turn these ambitions, if I'll use a phrase, turn these ambitions into a reality. It's unclear at this point. I think it's very uncertain, and I do believe that investors can get frustrated very easily. But at this point, I still think that there is some goodwill being afforded to Canada because of the ambitions and because of the belief that maybe there was a change, a large enough change, that could generate some of this investment. There are risks. I'll talk about a few risks. I mean, outside of just making good on these promises. Of course, there are the provincial referendum risks. But, obviously, aside from that, there's also the CUSMA risks. if you look at the list of demands from the US side, I think a lot of people breathed a bit of a sigh of relief. The list of demands from the US side for Canada leaves room for negotiation. I won't go into this in a very detailed way because that's not the focus of today's presentation. But, assuming our base case here is correct, that at the end of 2026, outside of, some volatility and a lot of back and forth and noise, maybe we get to a deal that is not all that different from the current deal in terms of the benefits afforded to all three nations as a result of this trade deal. I think that it will turn into turn a headwind from the uncertainty into a tailwind where people and businesses hopefully have more certainty. I mean, the middle ground is maybe that every year we have to go through this process. Hopefully we're not left there, but certainly we don't want to be left without any trade deal. So that's the worst case scenario. Our base case is that we look at this list of demands from the US, and I think there's something workable there. So, optimistic on that front. But, I mentioned this earlier. These are all the reasons, maybe people are putting more money to work in Canada, but where is that more money coming from? Well, it's because globally, there has been quite a market shift in attitudes towards investment in the US. Some people call it sell America. I don't like that term. I don't think it's representative of what's actually happening. But what is happening is that the marginal dollar of fresh capital is not as attracted to the US economy. Here's a statistic that one of my team members found and published in some research. The pension fund industry in Canada as a whole has about $100 billion of fresh capital, new capital to deploy each year. That includes investment income and contributions from future pensioners. How will they do that? Well, what we're hearing from them is that the marginal dollar of capital is less attracted to the US, and maybe at the margin more attracted to staying here in Canada. A few reasons for this. I mean, one is there's huge rollover risk in the US. I don't want to spend too much time on the US fiscal situation, but this is the amount of sovereign debt maturing in the next 12 months as a share of nominal GDP. You can see that right now, there is a lot of US debt that needs to be rolled over and needs to find a buyer. Obviously, that is scary. The US is on an unsustainable fiscal path, and that does not attract buyers. I mean, some people will say to me, well, you look at treasury yields, and treasury yields don't look like they reflect much worry at all. I mean, you look at the left-hand side of this chart, and that's the chart of the 10-year US Treasury bond yield, and it's been in a range. It's been in a range for, almost 2 years, and stuck in that range. The average person would say, well, there's not, a spike in interest rates, so certainly, it seems like demand is not waning. But then look at the right-hand side. Here's an interesting chart. This is the share of countries purchasing US Treasuries. And it's been quite volatile, but it does look like, the risk is towards the downsides. Fewer and fewer investors in certain countries want to keep pouring money into the US Treasury market for whatever the reason. And then you look at some of these headlines on the left-hand side here. The Danish pension fund is selling $100 million. That's a very small amount, but I think it's a signal. Sweden's Alecta sold most of its treasuries since early 2025. Japan's bond meltdown spurs speculation of GPIF portfolio shift. And Canada tells pension funds to invest at home in age of economic nationalism. And then you look at the right here, and you see the breakdown of the cumulative change in 10-year treasury yields since the presidential election. And you can see two things happening. Investors are betting on a lot more rate cuts. That's embedded in the expected short rate there. But they're also embedding a lot more term premium. So investors, while generally they're looking for the Fed to cut rates more than they were expecting in November 2024, they are also demanding more compensation for taking on this duration risk. And we can debate what exactly is term premium is composed of, but you can see it has certainly increased since November 2024. It's been hovering in a range of 40 to 60 basis points. You look at who's buying still, and I talked about the countries that are buying, but now let's look at the types of investors that are still buying in the treasury market. It's very much dominated by private sector buyers and official institutions, which we would think of as central banks, sovereign wealth funds, public pension funds, have all been net sellers since November 2024 of US Treasuries. And that's despite obviously the Treasury market growing over that time. They have been net sellers. The huge buyers have been in the private sector, and I want to talk about breaking that down even more. Some private sector buyers are very steady hands, very sticky buyers. They're buy and hold investors, the type of investors that any issuer wants to see. However, what we have seen is that within the private sector, there has been a shift even further. So you see, official sector buyers are very much buy and hold. That's what a very narrow distribution around zero says on this chart. This is the distribution of monthly foreign US Treasury flows by country or investor type. Private sector is wider, but then you have the average of the Cayman and UK. Why is that so wide? Well, those are custodial hubs for hedge funds. And so when we see buyers in those jurisdictions pick up, that tells you that official investors are stepping back, hedge funds are stepping in, and obviously hedge funds are less interested in holding for the long term, in the safety, safe haven attributes of an asset, and more interested in generating alpha, generating profit. And they will go in and out very quickly, and they can, if they become, a large enough part of the buyers group, can demand more compensation for that. And I think that's one of the reasons you've seen term premium rise. Another thing I want to talk about is Japan. Japan is obviously seeing a huge shift in its market. Oh, I'll just go back one slide. A huge shift in its local bond market, with yields finally, well above zero and offering some healthy coupon payments. But Japan is also, the single largest holder of US debt, particularly treasury debt. And Japan, the investors in Japan, tend to be a lot like official institutions. They tend to be buy and hold. Even less, more buy and hold than China, and certainly more buy and hold, as I mentioned, than the UK. They are still buyers. But at some point, or maybe I'll just say, at what point does the attraction of local yield start to weaken demand for US Treasuries? And I think it is certainly an open question. And I think it's something that people are generally worried about, even if you're not in Japan, because this is in some way, matters what other investors are doing. And it is something that we're watching very closely. The US dollar has rebounded more recently as a result of the chaos globally with regards to oil markets and the conflict driven by the conflict in the Middle East. But if you look more long term, take it from the beginning of 2025, the US dollar has depreciated quite significantly. If you're a foreign investor and you had money placed in the US and you took on unhedged currency risk, you've lost a fair bit of money. You've just simply put lost a fair bit of money. And that has come, very interestingly, despite the fact that the outlook for GDP for 2026 has been increasing over that time horizon. If you look at this, there was a brief period there of decline, but then it really picked up. People are quite bullish on the US economy, whether it's because of AI, whether it's because of other reasons, energy security, whatever it is, people are bullish, much, much more bullish on the US economy for 2026 than they are on some of the peer group. But the US dollar has still lost ground against the currencies of that peer group. And it really tells you that something else is going on. I mean, I think this change in sentiment globally in the demand to put more money to work in the U.S. economy is showing up in the currency. The reason, is partially because global investors are, started the period maybe November 2024 just so overweight U.S. assets. Not only treasuries, you think of equities, and you think of the huge run up in the Mag 7 stocks. I mean, any portfolio manager was just incredibly overweight US equities, obviously overweight US treasuries because of the safe haven attributes that they offer. But more recently, I can count a handful of times at least over the past 18 months or so where the dollar US treasuries have not exhibited those typical safe haven attributes. And if those correlations start to break down, big investors have to start turning the ship, and they will do so very slowly. And that's why I think this is operating in the background. I know, recently we've seen the US dollar rise in response to global risk attitudes taking a step back. But I think this is something that is operating in the background. It's happening slowly as these big investors start to change their mandates. And I think it's something that's ongoing. Coming back to Canada, maybe full circle, Canadian investors at large are one of the top two largest foreign holders of US equities. So, this changes every time we look at it. Canada is sometimes number one, the UK is number two. Obviously, the UK, as I said, is a custodial hub. Canada, the reason is, we have some very large institutional investors in this country. And I'm going to take a moment just to talk about what they have done over the course of the past little while with regards to their attitudes towards the US. I've sort of alluded to it earlier, but you can see here maybe I'll do it this way. Here, the difference between these two lines is how much of these large pension funds have hedged their currency exposure. And you can see the difference has increased between the percent of net assets held outside of Canada and the foreign currency exposure as a percent of net assets has increased. And so we have seen pension funds from their public disclosures increasing their hedge ratios. So they have less exposure, and we have other research showing this, less exposure to the US dollar. Why is that? You wanted a lot of US dollar exposure historically because of those safe haven attributes. Now, if they are more in question, you have to take on less risk and you have to take on less US dollar exposure. That does not mean selling US dollar assets. That means two things: hedging more of the currency risk embedded in those assets, and it means putting fewer new dollars to work in the US economy. And my colleague put this chart together, which I think is quite interesting. It shows you the exchange rate, USD CAD, in dark green there. And then it shows you the 12-month forward points. And you can see this two periods where the Canadian dollar is divorced from interest rates in the past year. One period we identify as when we believe that there was a lot of pension fund FX hedging going on. That was right after Liberation Day. And then more recently, earlier this year, we saw again the Canadian dollar divorced from interest rate fundamentals. And that was when we saw those really strong equity inflows. And so we do think that, this big Buy Canada movement, both globally and domestically, has seen some changes, at least temporarily, in asset markets. Now, at the moment, we measure term premium using the ACM model. We do it for a number of different countries. We have not seen term premium on Government of Canada bonds being depressed. That said, I am a strategist. I will stick my neck out here and put a forecast down on paper for you. That being said, we do expect to see that occur over the next year. So you can see on the left-hand side here, we have the Government of Canada yield curve, the current, and then the forecast. And what you see there is a flattening of the yield curve. we believe that the strong demand for Canadian fixed income globally and domestically is going to put some downward pressure on the term premium embedded in longer duration bonds here in Canada. And the opposite is true of what we believe in the US. We see the US yield curve steepening between now and the end of the year because there is more term premium embedded in the US Treasury market. Why is this? Okay, number one is because, as I said, we expect these flows to continue coming into Canada. Number two, we expect that the USMCA uncertainty fades, or the CUSMA uncertainty fades. We expect that some of the provincial referendum risks fade. And we expect over the course of the next little while, the Fed is going to move probably to having a smaller balance sheet. The Bank of Canada has laid out its plans. At some point, they're going to actually start buying bonds again to replace assets that are maturing and falling off the balance sheet. That is not the case in the US. You will see that Stephen Miron just put out a paper on this. It's well known that this is one of the things Kevin Warsh wants to do when he takes over the leadership at the Fed. So for these reasons, and of course, the overarching umbrella of a little bit less interest in the US globally, we expect that more term premium is embedded. So it's not just a foreign exchange phenomenon. We expect it to display itself in asset prices like fixed income. We still see again Canadian the TSX outperforming again this year. I think that it is part of our core views here at Desjardins that Canada has become a very investable place. Now, to keep it there, we have to execute on some of the plans that we have as a nation, as businesses, and we have to see that come to fruition. But for right now, investors are certainly looking very favorably on Canadian assets, despite the U.S. economic performance. I talked about, the AAA rating. I didn't talk about the fact that, our population, yes, we have our differences, but we're nowhere near as divided as a lot of the other peer countries that we're always compared to. We have, a very diversified economy. And right now we have things that are in demand globally. If we can get those to market, I think that's going to help a ton. Both foreign and domestic investors have the ability, the scope. I mean, as I said, a lot of foreign investors are underweight their benchmark for Canada and the willingness to continue buying. And market participants generally are more skeptical about the U.S. dollar and treasuries, about their hedging, their safe haven attributes, the returns that they might see over the medium term. CUSMA and provincial referendum risks, I think, are going to create bouts of volatility in the near term. But our base case here is still pretty sanguine. And even as the Iran conflict continues to drive broader investor skepticism across markets, I really think that Canada remains in a position of strength. I mean, the increase in oil prices is a case in point right here. That should, on net, benefit the Canadian economy in aggregate. I mean, it should lead to more demand for exposure to Canada because of the robustness of the economy in the face of these risks. You look at other economies in Asia, in Europe, they are very fragile. To use, the description that Taleb uses in the face of these risks. So maybe I'll leave it there. I'll wrap it up, the official presentation portion of this session, and I'll open it up to questions.
Thank you, Royce. This was an excellent presentation, very informative. We have a lot to discuss, so we'll get right into the Q&A sessions. And I would invite everyone to, again, please submit your questions through Slido for Royce. So I guess if I were to take away a bit of a messaging from this is that you're generally positive in terms of where we stand at the Canadian economy, that we're in a lot better shape than many of our other peer jurisdictions and peer economies. And I did like your analogy that we seem to be the clean shirt in a pile of dirty laundry. So a question then, given the global investors view Canadian sovereign bonds as a safe asset, and this bears out in the recent numbers that StatsCan put out, 12.9 for January, 12.9 billion were invested in federal bonds, 6.8 billion in provincial bonds. But we do have our own economic problems as
Yeah.
well. What are you at all concerned that maybe this understanding, this perception that the Canadian bonds are a safe asset, that this might suddenly reverse itself, that there might be a sell-off? And I'll add a bit of context to this. I mean, the federal budget announced 70 billion in deficit. Recent Ontario budget last week, 13.8 billion in deficit. Alberta and BC budgets, significant deficits, and Moody's has again downgraded BC's debt rating. So granted, we're in a lot better shape than many other jurisdictions, but we do have our own problems. What could happen? What is the worst case scenario if this notion that Canadian bonds are a safe asset suddenly begins to wane, and there could be a sell-off?
Well, worst case scenario, I don't think we know, but a really bad case scenario, I would say you can just look back to the 90s, right? I mean, I think that's a pretty good case study in a scenario that we never want to be in again, where global investors were very afraid to put money to work here. The Canadian dollar depreciated, bonds started to embed more term premium, more risk premium in them, and that's a situation we don't want to be in. How concerned am I at the moment that the inflows evaporate or even turn into outflows? I'm extremely concerned, and it's the reason we're watching this very closely. And I think there's 2 points. You talked about the budget risks. I mean, those are very top of mind for us. We are watching these budgets very closely, the provincial budgets, but particularly we want to see what in the spring what the federal government plans on doing. I think at the moment, we want to see things on a sustainable path. We want to balance fiscal sustainability with economic growth. We don't want to pull the rug out from under the economy just to try to narrow fiscal deficits. But at the same time, to your point, we want to maintain a forward momentum on maybe getting debt to GDP ratios down. And so, we are watching this. I don't think that it is a huge roadblock just yet. But the other thing we're watching, which I think could turn into a roadblock even sooner, and I don't really have a timeline on when, is the execution risk that I discussed. So there's been a lot of plans being made, some announcements, but a lot of big plans and promises being made, and that is true with any government. But I think this particular government, there was buy-in globally from investors. I mean, I talked to investors around the world, and there was buy-in. If that doesn't turn into, real investment, real changes, that could, turn around very quickly. And I don't know the timeline. It is very much, market psychology. But that is something that I'm very worried about, that each month we go and we don't see material progress on some of these initiatives, that we start to lose the goodwill that has been afforded to the country, to the assets, and to the issuers. And it's very hard to get that back. We're in a very fortunate position right now. We have the opportunity to take advantage of this money that is flowing in, and I think we need to figure out ways to put it to good use.
Very good. Thank you. Question from the audience. On capital inflows, is it mainly concentrated in Canadian government bonds instead of private sector and the stock market? And if so, the economy does not quite benefit from the capital inflow, or does it?
Yeah, so, over the past year or so, it's absolutely true that a lot of the money coming in has gone into Government of Canada bonds. I think that is a good news story. It's a reflection of the fact that I think investors are viewing Canada's AAA rating as a safe place to put money. We've done some statistical analysis. We do notice that Government of Canada bonds are exhibiting more safe haven attributes than they did before, and that's part of that diversification. And I would argue that if we didn't see those flows, benchmark rates would be even higher, where there would be more term premium than there is right now embedded in longer duration bonds. But more recently, we have seen very clear evidence of foreign demand for equities in Canada, Canadian listed equities. And so that is, to the questioner's point, putting money to work in the private sector. We saw a really strong demand last year for corporate bonds and provincial bonds. So I want to just, take a moment to say that on our trading desk, we heard from clients, global clients that, we hadn't heard from a long time. Obviously, getting back into maybe the Government of Canada market, but extremely strong demand for provincial issuance last year, extremely strong demand for corporate issuance last year. And so there was strong demand to put money to work outside of just the federal government. And I think, more recently that has been reflected in the equity foreign investment into Canadian listed equities, but all of last year it was in evidence in the corporate bond market and provincial bond market.
Excellent. In one of your slides that you'd put up, you showed the significant inflow of foreign investment into Canadian assets. I don't remember, you might have done this, but I don't think I saw a distinction between US and other non-US foreign investment. There was a bit of an interesting observation that US portfolio investment into Canadian debt hit a record 150 billion in 2025, while non-US foreign investment weakened to its lowest level since 2018. Have you observed this, and what could possibly explain? I guess the sense is that while everybody else is buying US treasuries, the US is buying Canadian debt. Have you noticed that at all? Has that come across?
I did notice it, and I'll be quite honest. I don't have a perfect answer, but I will speculate on a few reasons why. One is that the Government of Canada market has become much bigger and much more liquid, and so there's a lot more that larger investors can do in the market. So specifically in the US. And in some ways that might crowd out some other foreign investors, right? I mean, there's only so much demand, but these guys can now go in bigger and get out bigger in bigger trades. And that has helped. And so, I think that that's one reason. Another reason is that, on an FX hedged basis, there was a decent pickup in GOCs versus US Treasuries. And so, you might have had some extra demand on that. And then just from a diversification perspective, I think there are US investors that want to find other places to put money to work. They're putting a lot of money maybe to work outside of the Treasury market, and we're seeing it in our Canadian data show up in Government of Canada bonds. And they may be putting money to work all over the place globally. In Europe, they also want to diversify outside of maybe some of their traditional holdings of assets. And so they're finding other places, but they're not as maybe tied to just putting the money to work in Canada. And so, I think the trade ties help recycle that money into Canada with the US, whereas Europe, places like that, we don't have as much.
Very good. Thank you. Another question from the audience. Do you have a view on whether the Canada bid from international investors translates into investing in the early stages of major office projects? Or do you see the Government of Canada having to play a role in participating in the early stages, for example, via loan guarantees and so on? So, the Carney government is promising significant investments in infrastructure. Will these attract enough foreign flow or investments, or does the government actively have to provide either business support programs or subsidies to attract investments?
I think what I can say about that is that we're at a time where we have the opportunity to do as much as we can without those supports because of the interest in putting money to work in Canada. So that's from foreign investors, but also from domestic investors starting, again, to try to partner with the domestic pension funds to try to address their concerns about investability in this country, which all of these things did not have to require subsidies or co-invest, things like that. That being said, I mean, I think, a number of these projects will require the government to take an active role. However, I think we're at, maybe the best position we've been in a long time for attracting foreign private sector capital or domestic private sector capital.
Is gold part of the foreign inflows? So do you view gold as part of the foreign investment in the Canadian market, or is that separate from some of the slides that you had put on?
So that's separate. I mean, indirectly, I think, a lot of the money that had been put to work, maybe in the TSX, some of it was chasing the exposure to gold. embedded in that index. But we are monitoring the large shipments of gold that we are seeing show up in the trade data. It's very fascinating to watch as these shipments take place and as this trade takes place, because we have to now in some months measure the trade data excluding gold shipments because they're dominating the movements, and they don't really have an economic value. They are more of an investment sort of theme. They don't have an economic value for manufacturing or something like that. But I do think that there is more interest in Canada because of its exposure to natural resources, and gold had been shining very brightly, but now it's oil, and I'm sure at some point it'll be critical minerals. We have the things that people want, and I think that's the underlying message.
Oh, I hesitate to ask this question a little bit because dealing with crypto assets always sometimes gets
Okay,
poked.
go for it.
All right, there we go. So the risk of flight from crypto assets on the short end of the curve. So how do you view, I guess, state of play with crypto assets, and are you concerned about a sudden flight of capital from crypto?
So we're thinking about this in terms of money leaving the short end of the Government of Canada curve and going into things like stable coins. Is that right? Or is it
I don't
just
have additional
generally?
context on it, but I think the essence of the question is capital flight from crypto and sort of the impacts on the yield curve. So I guess where that money would go, would it go into bonds, or would it go into gold?
Yeah, I'm not really too worried about. Sorry, it's going from crypto to bonds.
Yes, risk of
Oh, okay.
flight from crypto.
I don't know. I think crypto is a speculative asset. What we're seeing now is a bit of a rebound. A lot of money has been allocated to it. I mean, we saw, but we were just coming off a really big drawdown,
Mhm.
and I don't think I've seen any evidence of it really moving markets here in terms of Government of Canada bond prices or bill prices or anything like that.
Okay. You mentioned Canadian institutional investors, and I think you alluded to the pension funds affecting net capital outflows through the global diversification strategies. Collectively, the big pension funds, the Maple 8, hold about $1 trillion in U.S. assets. In a worst case scenario, if something bad were to happen, a reversal of the movement out of Canadian bonds, government bonds, do you see a potential of a return to the imposition of an imposed cap on the percentage of for Canadian investments in foreign assets? So sort of a pre-2005 era that we had a cap on the pension plans investing in foreign assets. Is that at all on your radar or
I,
not at all?
I mean, I've heard it. I don't think so. I mean, that money is not, uh, you know, the government's money, or it's not, it is the pensioners' money, and it is to be invested to the advantage of those pensioners. And so it is not, some sort of, fund for sovereign wealth fund to be directed. And so I don't think, I would foresee that. I would never say never, but, I think it's been pretty clear from the statements of public officials and generally from public officials and from the pension fund industry that is not something that is of interest. I think that you have seen public pressure. It's been pretty clear. I mean,
Yes.
from citizens to do more, and I think maybe that does creep into the mindsets of the leaders at these pension funds. But also, I think you're seeing more optimism surrounding Canada, so it makes it a lot easier. We need to do more, though. We need to get out of the way of the pension funds putting money to work here, and we need to talk to them. I mean, figure out where the roadblocks are. It's not just about the stagnation in the economy. There are specific roadblocks that the pension funds have identified that that governments need to address before they can put more money to work. And I've heard some incredible quotes about how difficult it is to put money to work here, and it does not have to do with stagnation in the economy. It has to do with specific roadblocks that need to be addressed.
I have another question from the audience. Your base case scenario had a fairly quick resolution of the Middle East conflict and CUSMA renegotiation success. What about a downside scenario of a longer conflict and CUSMA extension if it were to kick into next year? How will elevated oil prices impact us? So a combination of both CUSMA negotiation going sideways and also if the Middle East conflict isn't resolved anytime soon with elevated oil prices.
I mean, the outcome would be quite complex, but in an aggregate level, I would expect that it would be a higher oil prices. The result of a supply shock like this would translate into a net benefit for the aggregate economy. Eventually, the longer it remains in place, that could turn into take the form of hiring, capital spending, all of those things. But it'll be specifically focused in Alberta, Saskatchewan, and Newfoundland and Labrador. And then we would think about the regional fallout, which it would be painful in other places. Assuming that it did not tip any one of these provincial regional economies into recession or something like that, I would argue that it would still overall be, even if it's a modest net positive. The offset coming in the scenario that you outlined is coming from the extended timeline for the CUSMA review and the extended timeline for uncertainty hanging over business leaders trying to make decisions about investment or hiring. And so that would probably offset it, and I think you would be in a very neutral position at the end of it.
So building on that then, what are the key macroeconomic headwinds? Productivity stagnation, demographic pressures, weak business investment that could reduce the attractiveness or marketability of Canadian sovereign debt. So even in the absence of CUSMA and the war in the Middle East, we were beginning to see Canadian productivity had been relatively anemic over the past several years. So if that were to continue, and now we've got this additional added pressure of the external factors, I heard you when you said, again, we're in better shape compared to all of our peers. Maybe that's just the golden ticket for us because we've been very responsible in terms of managing the books. But at some point, something has to give. I mean, this can't, right? So what's your long-term view, I guess, of Canadian sovereign debt?
It's productivity. I mean, obviously, productivity is top of mind because of the stark contrast between our economy and the U.S. economy. Given how closely we're integrated, we cannot extract that productivity or harvest the productivity that is being seen south of the border. It comes back in part to demographics, though. I mean, the demographic slowdown is one thing, but it is another thing to talk about getting highly skilled people, highly educated people into the economy and working very quickly, getting them to achieve all of their abilities. That is part of the productivity conundrum. We had huge population growth and absolutely terrible productivity numbers because the people that were coming in, maybe largely students, were below average productivity. You know, that was mechanical, and I'm sure we'll see a at least temporary bump up mechanically in productivity numbers. But what we want is to see some long-term, productivity growth. Where I am somewhat optimistic is on AI. So the first leg of AI has been the build-out, the huge infrastructure build-out. And we have to do our own infrastructure building here, and we need to get going on that. But the productivity part of it will be the implementation for companies, listed companies or private companies in this country to implement the AI tools that are now being offered into their operations. And that's where I see a lot of room for growth. So when I talk to companies on both sides of the border, companies in the US are further ahead on this than companies in Canada. They have already embedded a lot of AI into their operations. And I think you're seeing more signs of it impacting the labor market there than it is here. Obviously, you have higher productivity. There's going to be some impact on the labor market. What we want to see here, and where I think there is room for growth, is across all of the industries that we see that are very large. Mining, retailing, financial services. All of these will benefit from implementing and using the tools offered by AI. And I think that there is another leg up, and I don't think that that is currently priced into valuations just yet. But I think very quickly we can just use off-the-shelf software or tweak it or develop, it in-house and take some of these companies' operations to the next level with regards to profitability.
Thank you, Royce. And as we approach time, we have about just 2, 3 more minutes left. Maybe as a final question, how sustainable are Canada's debt service costs amid rising interest rates and growing reliance on foreign investors to absorb roughly, I think it's around 7% of GDP in net annual borrowing? There's volatility in the bond market. This is going to have an effect. Bank of Canada is talking about raising interest rates now, again, just to counter the inflationary pressures because of the situation in the Middle East. So globally, I think there's this slow uptick in repricing of debt, and Canada isn't going to be immune to that. In terms of debt service costs amid rising interest rates, what's your general sort of comfort level, I guess, as to where we are now and where we could be heading?
I'm generally comfortable because of where we sit in the pack. And in terms of where I think our GDP growth can go in the years to come. It is, by definition, to take it to the limit, it is not sustainable. Is it more sustainable than some of our other peers? Yes. And I totally believe that we need to get our fiscal house more in order, but it takes, more medium or long-term planning rather than reacting to every news cycle. And I feel that a lot of economies globally, and I'm not just going to focus here in Canada, but a lot of economies globally had fallen into this trap that you chase every news cycle to keep voters happy. But, that is not instilling confidence. That is not instilling, resilience into the economy. That's what we need. And I think there needs to be people taking a more long-term view. We will see if the current set of elected officials is that group. Because to your point, we are not only seeing, central banks thinking about now, rate hikes in the face of inflation, but also rising term premium. You can see global investors are pushing back against the last set of what it's termed as group of elected officials and what they did. Global investors do not like it, and they're pushing back. And globally, term premiums have risen. And so we have to figure out who's going to buy all this debt. And if we can be in a better position, I don't know if this will materialize into a crash or something like that. But if we are in a position where that does happen, we want to be the ones that will be resilient rather than the ones that will be extremely fragile. And you can see already which ones are extremely fragile. You look at the UK, you look at Japan, you look at their bond markets in the most recent context of volatility, and they're wild. I mean, they're very difficult to interpret. Canada's has been volatile, but much more mundane in terms of what we're seeing in other places. And we don't want to get into that situation, but we actually want to improve our situation over the coming years.
Fantastic. Thank you.
Thank you.
Well, I'm afraid that's all the time we have for questions. I know there were a bunch of additional questions that we didn't get to. This has been a very informative and excellent session. I would like to thank Royce Mendez for joining us today to share his unique perspectives on the Canadian macroeconomy, capital markets, and capital flows.